welcome to our podcast, Broker Banner Denver, where we are breaking down barriers to home ownership. I'm your host, Kim Davis, the real estate expert.
And I'm Patrick Williams, the mortgage guy. We're here to inform and educate about the home buying and financing process.
And on today's episode, we are going to talk about different mortgage programs. So the reverse mortgage and assuming a loan or an assumption loan, and maybe some other stuff, but we'll see.
Well, I'll probably give some interest rate updates.
Oh, yes.
I like doing that every week. And I might have some good news. So I feel like we should probably talk about it.
Talk about that.
Yeah. What other kind of stuff is going on?
My kid graduated today.
What?
And
what did we do with it?
We have a
It's
big
out
old
there.
fat head. Oh, go get it. You can edit that part out.
This
He'll
makes
edit.
good. No, this makes good podcasting. Here is Lulu.
Look at my daughter.
Oh.
Yay, Lulu. Look at her fat head. She loved it. So
I mean, this is called a fat head. That's
Yes.
what the product
Yes,
is called.
that
She's
is
not calling her daughter
correct.
a fat
Thank
head.
you. Thank
Yes.
you for that.
Just want to clarify.
Thank you for that. Yes. So we just earlier today, today is a Thursday, we went to Red Rocks, and she graduated from Chatfield Senior High School, and she's
So
done. She's my baby.
So you're officially,
both
like,
kids
done.
are out of the house. Well, done with
Not
high
out
school.
of the house.
Not out of the house, but done with high school. So that was exciting.
That is
and it
exciting.
was hot. I mean, Red Rocks is really pretty, and we had a friend who came in from out of state for graduation, and he was saying, man, I didn't realize how beautiful like Red Rocks is and how cool it is to graduate there. But
How do people not know? It's like the best venue in the entire country.
yeah, it was pretty awesome. And so she graduated, and then our friends who have kids that go to Columbine, they're at 2:00, and I can't even imagine. It was so hot at the 9 a.m. graduation. I was like, wow.
Well, didn't it snow when your older one graduated?
It did.
So I
she
mean, it
didn't-
seems like you
yes.
just never know what it's going to be like.
So when she graduated a couple years ago, she did not get to do Red Rocks. We had to go to Denver Coliseum.
'Cause
That
they had
was
to
their
move it
backup
indoor.
plan. Yep, we had to move indoor.
You never know.
Yeah.
You never know in May. I mean, it could be snowing graduation time or,
Right.
80 degrees, which is what we had today, close to 80 degrees.
it was- and you know
did you
what?
wear like a big hat or,
So-
have some shade cover, like an
No,
umbrella?
I wore what I'm wearing right now. And I did not bring a hat. And my daughter, Ava, my oldest, she is burnt.
So
a
how
little bit.
long does that how many kids graduate from the class of 2024?
You know what? I don't know, but I know that is smaller than my older daughter's class because when she graduated in 2022,
Mm-hmm.
they did it where two people said names and they did this cross where they,
So you get
like,
2 for 1.
Like they would say,
2 names and
Lulu,
Yeah.
Patrick, and then one would walk, and then as soon as they started walking, they'd say the other names, and they had both videos.
because
and stuff.
double time it because it takes so long.
And you want to know what's great? I don't know how long it's been since anyone's been to a graduation, but
Last year for
it
me.
used to be. So my younger brother, who is 20 years younger than me, he graduated in 2015.
Okay.
2015. And they had 12 valedictorians, and all valedictorians did a speech. They changed that, and it's only one. Thank
12?
goodness.
How do you have 12?
It was horrible.
I thought it's the best student. That is the valedictorian.
no.
And then there's like a second one.
Now everyone has like 4.8s. There's
know.
like valedictorians, salutatorians.
Salutatorian is usually
And
number
so,
2.
yeah, but they only had one valedictorian speech, which was great, and then a couple other, from the students.
My son,
it was awesome.
My
It was a
son's
good graduation.
girlfriend, she's graduating from Arapahoe.
Okay.
And she was nominated to be the keynote speaker.
Oh, that's
We
great.
happen to be leaving out of town that day. So we're trying to figure that out for him. So
no.
yeah.
For the
We're going on
cruise.
my wife's parents are celebrating their 50th wedding anniversary. So we're doing a family trip. All 21 of us
Wow.
are going on a boat together. It's a big boat.
Yeah.
But it should be fun. We're going to celebrate them and their legacy.
And I think what you told me is that you've never been on a cruise.
I haven't. No.
Cruises are
I think
fun.
it's going to be great. I'm sure it's like a resort on, it's massive.
Yeah.
It's a big boat. I just don't do great with like
You still get-
schedules and like herds of people. Like I have issues. So like my idea of a vacation is like a cabin in the woods where I can take my bike and, a fishing
No.
pole or something.
It's fun. Cruises are fun, but
Yeah.
it is interesting because even on a big boat, you still feel the ocean.
Yeah, so I've got a
sometimes.
bracelet. I've got this bracelet that's like a pressure point bracelet supposed to help with seasickness. And then I've got, thankfully, a prescription for some motion sickness stuff.
My goodness, I never took those.
Well, I want to, I don't
Are
know.
you seasick?
I get, so,
I get
you know when I get
carsick.
motion sickness is at Disney World. I get
Oh,
motion
I
sick
get
because
that
like,
too.
I'm usually fine with like roller coasters and stuff.
CGI.
Yes,
ride.
it's the Disney
Yes.
ones that like try to trick your senses.
Yes.
That's like a screen and movement and sounds. And I'm like, my brain's like,
Okay.
I'm too smart for this.
So we did Disney during COVID.
Yeah.
It was amazing. It was
'Cause there's nobody
2020.
there?
There was no one there. You had
Yeah.
to like make reservations and like jump through all these hoops. And
Yeah.
when you walked through, what's the one with the ball
Epcot?
that everyone eats? Yeah. Epcot. When we did Epcot,
Yeah.
you had to stop in place, pull down your mask, drink, put your mask back up, and then you could start walking. They wouldn't let you walk and drink your drink around Epcot. It was so funny.
Well,
And
okay.
then we just did it anyways.
do
and then we'd get
we
stopped.
do we look back on those times and just think about how ridiculous some of the
Yes,
rules
I thought It
were?
was ridiculous at the beginning.
Like, okay,
but-
if you sit down at the table, you can't catch COVID.
Right.
So you can take your mask off while you're sitting down. But if you have to get up and go to the bathroom and you're walking to the bathroom or leaving the restaurant, apparently COVID is higher in the air.
Right.
I don't know.
I think that they're a lot more lax about it just because everyone should have some sort of immunity at this point.
They should. Yeah.
I
At
got
this-
the original strain before the shots came out. So I've never had it a second time. So anyway.
Yeah.
Yeah.
No,
It'd be great.
it's just funny to kind of look back on some of those things
Yeah.
and like the rules that they
But
instituted.
Disney was great.
What was?
Well, Disney. And
Disney.
then
I'm
I
sure
think
because the worst part about Disney is just all the
the
people.
lines.
Yeah.
Yeah. And there were like no lines. And then you had to be, what was it, 5 feet from, or 10
Perfect.
feet? So then
I actually-
the next group was like 10 feet.
I've been
And-
practicing social distancing for years.
That's just
I
you're
just got to.
grumpy.
Everybody else had to also, and it was fantastic.
It's just
but
because you're grumpy.
well, I'm not grumpy. I just like, you know what?
He's
I think,
not grumpy.
I think, in our business, we deal with people a lot. And so a lot of times for me, like to get away is like go have some solitude time. Like
Right.
that's why I like mountain biking and doing
Right.
different things
No, I
outside
agree.
and getting away. So
We
I
love helping people.
and I love
Yeah.
I love people.
Yeah.
I mean, helping people and getting to know people.
Right.
I am energized by new relationships and getting to know
Right.
people.
Yeah,
So,
me too.
Yeah.
So that's probably why we like what we do.
Probably.
Right.
Yeah, it's fun. Yeah.
So speaking about helping people,
Oh,
let's
okay.
talk about reverse mortgages. Actually, Patrick and I have done a reverse
We
mortgage
have.
recently, and we have found out that a lot of people don't know about reverse mortgages, and so we wanted to bring it to you guys so that if you are not able to do reverse, but maybe a parent or a grandparent or someone like that. So why
Yeah.
don't you explain what a reverse mortgage is?
So there's a lot of myths about what a reverse mortgage
Mm-hmm.
is. A lot of people think that you no longer own your home. And that's a myth. You still remain in your home and you're on title and you own it. So that's one myth that I try to debunk right away. And the second one is that you can never be like kicked out of your home if you have a reverse mortgage on it. So
what is a reverse, and who would be a good candidate for a reverse?
So a good candidate for a reverse mortgage is anyone over the age of 62 that has a lot of equity in their current home.
It doesn't need to be paid off.
Doesn't need to be paid in full. They need to probably have under 50%.
Okay.
If they have any more than that, they probably won't be able to qualify. Typically, there's at least a 50% equity requirement in a reverse mortgage. And the primary benefit of a reverse mortgage is that you never have to make a payment on that loan as long as you remain in the house. So if you move, then the loan has to be repaid, but it's repaid as you sell your home. So as long as you live in the home as your primary residence, you never have to make a payment on it.
That's amazing. So let's just make sure that we, 50%, you have to have 50% equity. So that doesn't mean 50% that you paid it down 50%, correct?
No, that means
Because-
50% of the current value, not the price that you bought it at.
Correct. So
Yes.
I think
Most-
some people might think the other way, though, that they had to pay it down 50%. But especially here in Denver, with how fast homes have appreciated.
I think I just saw something about how most homes have appreciated close to 50% over the last 4 to 5 years.
Since 2020, so there was an article on Fox Business that said U.S. home prices have surged 47% since the start of 2020.
Which was COVID, the COVID year.
Yes.
And a lot, I mean, a lot happened during that year. Really low interest rates, the work from home.
Right. People were at home more.
They wanted to get out of city center because they didn't have to commute. So a lot happened. But I mean, if you bought prior to 2020, essentially, you would have at least a 50% equity stake in your home.
Correct.
That you should.
So then most people of the age of 62 or older, probably if they owned before, may have 50% equity in their house.
Yeah.
So if they're struggling to, like, let's say they...
Well, so let me kind of... There's kind of 3 different types of reverse mortgage. The one that you and I did was a reverse mortgage for purchase. So we helped this person get into a new home because their living situation changed a little bit. They needed some help from family, so they needed some more space. And they took the equity that they had in their current home and they transferred that equity to the new home, and the difference was borrowed on a reverse mortgage. And she'll never have to make a payment on that as long as she remains in the home. So that's the reverse mortgage for purchase situation. The other one, most of the time...
Let's just stop right there just so we can kind of,
Yeah. I know sometimes there's a lot of information.
So that was a reverse mortgage for purchase. So what happened for our clients is they had a condo and that was completely paid off. And so they needed a bigger space, but she no longer works. She's on a fixed income. She had like a pension. Right.
Yeah.
And so she didn't have a lot of incoming money like you do when you're working. And so, but they needed a bigger house because family members were coming in to, help her as she aged. And so they bought a bigger house and used that equity, transferred the equity from the condo. So we sold the condo, took that, bought a new house, and basically
borrowed the
difference. So it was a difference of a couple $100,000, and then she could still live there rent free, basically.
Yeah, she never has to make a payment on that loan as long as she lives there as her primary residence.
So then what happens when she, let's say, either passes or decides to move out?
Yeah. At that point, the mortgage would become due, typically within 12 months.
Okay.
The family or the heirs to the property, so if she left the property to her,
or wherever,
they always have the option of buying it back from the bank at 95% of the value. So the bank is always going to give the family the first option to purchase the home. If they decide that they don't want to do that, they can go ahead and they can sell the home, and then they just pay off the mortgage as if they would pay off any mortgage. And if there's still remaining equity over and above the current balance, then that would go to the heirs of the property.
Okay, so that 95% of the loan.
Well, no,
they pay off the whole loan, but let's say because you
95% of the value of the home. So when that comes into play is if you did a reverse mortgage 15 years ago and that mortgage balance has continued to grow.
Okay.
And so what that does is protect the homeowner from ever becoming upside down.
Okay.
So if the value of the home, they usually will look at it with a 4 or 5% appreciation rate.
Okay.
And they'll give you, based on the way the interest is going to accrue on the loan, because you're not making a payment on it, but interest does continue to accrue, right?
Yes.
So that balance goes up every year.
Correct.
But there's a schedule that they give you that kind of compares, here's what the estimated value of the home will be every year, and here's the estimated loan balance.
So if, let's just say, there's tons of equity in the house, I can just pay back the reverse of what is owed, correct?
Exactly, and like a typical mortgage where you would just sell the home and pay your loan off, and then whatever remainder is yours as proceeds from the sale.
And that's why I want to make sure that the viewer understands.
And that's one of the myths. Yeah, is that somehow with a reverse mortgage, the bank now owns your home. And that's one of the myths that people have believed. And reverse mortgages, I think, did get a bad name. I do think there were some predatory people out there who probably took advantage of people, but I think it was during the Reagan administration, they put a lot of safeguards in place, and now the majority of reverse mortgages are actually FHA insured.
Okay.
So
All right.
they're through the Federal Housing Administration. There's a lot of education is a big part of that. You are required to go through some counseling where they go over the specifics and make sure that you truly understand
Right.
all
They
of.
want to make sure that the person who's getting the reverse is doing it on their own free will and not being coerced.
Yeah, and they want to make sure you understand how it works
Right.
and what you're getting into.
Okay.
So, I mean,
A little bit of both.
that was a
Yeah.
big part of when Reagan instituted some, overhaul of the reverse mortgages and put some parameters on what was allowed, is that you have to go through that counseling
Okay. I
in
think
order to
that's
do
smart,
that. Yeah, it
because-
is. It's a
because like
protection
you
for
said-
the borrower.
Protection for the borrower, and there's so much misinformation out
Yeah,
there.
there is. So we have a whole. I'll put this up and we can add a link. We have a whole website with videos and frequently asked questions that kind of goes into depth if you have questions about reverse mortgages. So we'll make sure to share that as well, because education is a big piece.
Absolutely. We'll put that in the descriptions on the YouTube.
Yeah.
Page.
So-
okay, so then that's one reverse.
Reverse mortgage
So
for
we have-
purchase.
Okay.
So the other two, there would be considered like a refinance. So
Okay.
you own the home, maybe it's free and clear, maybe you have a small balance, but you live, on a very fixed income. You have maybe Social Security coming in, maybe a small pension or retirement, but with the way inflation is, everything has gotten so expensive. And so there's a lot of these people that have expensive homes that are worth $750 or more $1,000, and it's paid off,
Right.
but all of that money is locked into that home, and they don't have enough money to go out to eat on a Friday night or take a trip or do anything. So what these refinances do, one is like a home equity line of credit.
Right.
So we will
But
do
is it a different way to qualify for it, since they are on a fixed income? So it could be that they can't get the traditional home
They're-
equity line of credit or a first or second,
Yeah.
right? And what's nice about it is no payment.
no payment. They never have to repay it. And there is a different way of qualifying. We look at what's called residual income. And the most important part of residual income is how much money you have left each month after you've paid all your bills. So it looks at, hey, we have $1,000 left. And then, so there's limits depending on how many people are in the household.
Right. Okay.
Yeah. So the first is that home equity line of credit variation. And the way that works is you take out that reverse mortgage, and then you basically have access to the equity in your home, and you can draw upon that as you wish. There are usually some limits within the first year.
Okay.
They limit how much you can take.
Probably
There's
smart.
Probably, yeah, just make sure,
Right.
but you have access to those funds basically as you will. The other piece would be more like an annuity, is how I would describe that. So
This is the third.
the third
reverse.
option, and the way that works is we set up a distribution that would be
yes.
like a monthly distribution.
Yes.
So, hey, we want $1,500 a month. We feel like an extra $1,500 a month would help us immensely. So we set it up and we draw $1,500 a month off of that mortgage every month, and we
Okay.
send a check, and you have that money to live off of.
Wow.
So, I mean, it could be.
I didn't
it could-
know about those other two because obviously I'm a realtor. We did the purchase, but
Yeah, which was amazing, right? I mean, we were able to help.
It helped. We helped a great family
Yeah.
who thought that there was no way that they were ever going to be able to buy bigger, and how it was going to work for their family. And so it ended up being a huge blessing.
So I think, the reverse mortgages is a tool that can be utilized in order to enhance quality of life during their retirement years.
Yes.
And I actually am working with a financial advisor on another one, and he came to me and he's like, I have this client, and every single scenario that I have run tells me a reverse mortgage is her best option. And it's because she has no heirs to
Right.
leave a home to. So she can pull out the amount of money to buy a house cash.
Right.
But then that's that asset. It's just sitting there doing nothing. To where a reverse mortgage, she never has to make a payment. She keeps the funds liquid. She doesn't have heirs to leave the property to. So
she doesn't have to borrow against it. She can. But the fact that in those later years when you're on a fixed income, it's nice to not have to have a payment and to not feel that pressure of it's going to foreclose or it's going to
and they can never take you out of your home. You're always, as long as you live there, you're welcome
and
to
you
stay.
Can own it, and you can pay it back, or you can sell, pay it back, and it's still under their what did I say? It's on trust. It's still under their.
Yeah, if their name on title or their trust is on title, and then the mortgage would be just like a traditional mortgage, would be a lien on that title that would need to be released upon selling of the property. But what I've seen and from what I've heard through some of the stories, is that this can make a massive impact in people's lives and their quality of life. So, if there's somebody out there that you think could benefit from maybe an extra $1,000 a month, or, maybe...
Or wants access to the equity in their home without a payment, who's of 62...
You have to be at least 62 years old.
Okay.
Yep. And the, each scenario is different.
Right. And so, obviously, it's a newer subject that, people haven't been talking about until, people have talked about it forever, but it's had a bad reputation, a bad rap. And so, reach out to Patrick and see if you're even curious or if you just want more information, because every
situation is different. Yeah, and it does have a lot to do with your age, right? So, but I think helping people have a good quality of life in their later years, especially as we're having a large aging population, right? The boomers are all reaching retirement age. And it's not for everyone. There are some people who are extremely against them. And I'm not saying this product is for everyone, but for the right situation, it can be a real lifeline. Yeah.
We're just hoping to get information out there to the public. So then another kind of mortgage we want to talk about that everyone keeps asking me about, especially in real estate, but I'm sure you get it asked too, is the assumable loans or assumptions. And so what that is when someone has a 2 or 3% rate on a loan that they have bought their house with, a buyer wants to come in and get that loan that you have. And there's only a certain amount of loans that you can assume. Most of them are FHA backed. Is that correct?
FHA and VA, I believe you can do as well. Yes. So government backed programs. Mm-hmm.
And so what is happening is people are like, hey, I want your 2%, your 3% interest rate, because now interest rates are, we'll talk about that later, but in
they're
the
higher.
6s, 7s, but they're higher than the 2 or 3s. And so they're like, hey, I'll buy that loan from you. You have to qualify. So there are some
Yes. So first of all, the loan that you are assuming is the seller's mortgage. Okay. Right?
Right. So let's just do, maybe this will be easier if we say Jack and Jill. You're buying Jack and Jill's house.
Yeah, apparently it's up on the hill.
So you're buying Jack and Jill's house. And
okay. And Jack and Jill, they bought back in 2020 when interest rates were much lower than they are today. And so their interest rate is 3%, right? And they're ready to sell their house. Their mortgage is $250,000. Okay. But the house is worth $500,000, right? So they're going to sell the house for $500,000.
Correct.
And you want to buy the house for $500,000.
Right.
But you really like the mortgage with the 2 or 3% interest rate. Correct. So you're going to try to assume their current loan. And so what you do is you go to that lender who did the loan back in 2020 and you say, we want to assume this loan. Mm-hmm. And you have to basically re-qualify. So the lender who's currently servicing that loan is going to get as much documentation from you as I would under a new loan. And they're going to essentially approve you that you can make that payment and that you're creditworthy to have that loan.
And so now we have this, let's say that it happens. It's a lot harder than that, but let's say that
It's really
approve
hard.
you. It is hard. So assumable loans are not as easy as everyone thinks, but let's say that we got approved. And so now we have promised to pay the seller, Jack and Jill, $500,000.
That's
and
right.
We now only have their $250,000 loans.
That seems like a problem.
Where does the additional $250,000 come from?
That's a good question, Kim. So typically what you can do is you can take out a second mortgage.
Okay.
Or a home equity line of credit, something like that. But most of those loans don't go above an 80% loan to value. You can find some. There are some that can go to 90. But you're not going to be able to finance the 95, 97% as you would if you were getting your own mortgage.
Right.
So this typically doesn't work for somebody who has limited down payment resources because you still have to buy the house for $500,000. Right. So where are you coming up with the other $250,000? Right. So you got to get probably another $150,000 loan. And then the other $100,000, which would be 20%, you would need to put down
as cash
from your own savings or retirement.
Right. So it's basically like someone who has 20% down on a house. Maybe it can work. Now let's tell you that I've been doing this 22 years. I've never had anyone successfully assume a loan, but it is a conversation that people are having a lot more and are questioning about it. We will, of course, always try, but it is hard because the bank really has no incentive.
What is their benefit of having you assume that
Right.
loan? I don't know that there is much. And so the dangling carrot to have them help you is it's just non-existent.
Right.
And so
jump through a lot of hoops.
They do. And I mean, I had a house for sale on my block. And I started calling that realtor. We developed a relationship, and she kind of would call me and give me updates on what's going on with this house. And they had a VA loan, and they were trying to assume it. It took over 90 days for that to go through, and then they said they wouldn't do it.
Right.
So
do they give a reason why or not? They will.
They just, I didn't get into that much detail with her. Usually they come up with a reason why. Right. I think it's a good strategy, but you have to be ready to have a lot of frustration. I mean, what are you willing to do to get a 3% interest rate at $250, right? Or what in this situation? So if you're willing to do that legwork and fight with the bank in order to get that loan assumed, it might be a good option for you. And you're borrowing $250,000 at 3% instead of 6 or 7.
I mean, it sounds great. It would be great to assume loans. Hopefully, with interest rates, maybe we'll see more of that. We're at the, I think, beginning of that. I know they did it a lot in the 80s. I don't know how successful.
When interest rates are really high as well. Yeah, it's usually done in a higher interest rate environment. And that's kind of where we are today.
Right.
I know some people who have been successful in getting it done. So it's a great strategy.
Right.
If you have roughly 10 to 20% down.
And also you need a seller probably who's willing to assume, right?
Yeah.
Assume and willing to wait.
Because you're not going to get a 30-day close with an assumption.
Correct.
So if they're willing to do that for you, most likely you're looking at 60 to 90-day close.
It could be great. I'm just thinking it could be great for like a family deal if mom and dad are,
that happens quite often actually, where they basically sign the loan over to their daughter and her new husband. Right. We're just going to let them take over the loan.
And then, they can figure out the financing.
Yeah, there's other ways of doing that too when it comes to family. If the family moves into the house and just starts making the payments and they can show that they've been making the payments for the last 12 months, then you can actually have it transferred over that way as well.
Well, I didn't know that. And be considered assumable.
Yeah.
Yes, because it's transfer is assuming.
Yeah, it's basically what you've said is I'm taking this loan over. My parents have moved out. We've been living here the last 12 months and making the payments.
Wow.
So we want you to put it in our name now.
Oh, that's great. I didn't know that.
Yeah.
So, look, I learned something too. That's awesome.
All kinds of nifty tricks in the mortgage biz.
So those are, a wrap up, I guess, of those two loans.
A pretty high level overview,
yes.
right? If you have more questions about this, give me a call. Check out our website. We've got a lot more information on there.
So you have good news for us? Interest rates?
I do. I do.
This is the second week in a row.
I know. Isn't it great? So we did hit, 2024 highs about a month ago.
Right.
And since then, We've been well above 7%. We had the Fed's favorite inflation reading come out yesterday, CPI. CPI excludes the more volatile like gas and rent. And then PPI, which is the producer's price index, includes gas. And so the Fed likes CPI better because it excludes gas and rent, which seems to be a lot more volatile.
Seems like a great opportunity to make some fart jokes, but I'll hold back.
So CPI came in lower than expectations. It came in lower than March's reading. So we are starting to see at least come back down a little bit, level off. The bond market was very friendly to this. We're back to the point we were at that April 10th. So we're kind of back up at that same resistance and getting off of those 2024 highs.
Yay! Let's hope it continues to trend down.
We want to keep down in that direction. Right. I do, the Fed has said we're comfortable higher for longer. We're not in a hurry to start cutting rates.
Correct.
I mean, all of their...
but still to see a little bit of relief.
Oh, it's great.
Yeah, it helps buyers so
much. It's amazing just what a quarter percentage point does on a mortgage payment. It really, a couple $100. Yeah. And I know every little bit right now helps. So even, $100 or $200 on a monthly payment is huge. Absolutely. So it is really good news. I'm not expecting the Fed to start talking about interest rate cuts. They did basically say we're not going to raise interest rates anymore. We think we've reached the restrictive level that we need to be at. But we are in an election year. Typically, I'm thinking we may see a cut before November.
Mm-hmm.
Huh. That's kind of my prediction.
We're May.
That's kind of far away still. But I think as long as we can kind of keep where we're at and we start to see inflation coming down, just because the Fed doesn't cut, that doesn't mean interest rates don't come down.
Right.
We'll still see interest rates start to come down the closer we get to an expected Fed rate cut because the market is trying to anticipate.
I was going to say predict, anticipate.
Yeah.
Okay.
So good news.
That's still great news.
Yes.
I mean, still great news from 4 weeks ago. So if you are looking to buy, I mean, there's no really reason. I mean, if it were to go down, you are predicting it's going to be more of a steady decline versus
we're not going to see a point drop in a month or two. That's not going to happen. I think we'll see just kind of a steady decline as we get closer to November.
Let me tell you, our couple of clients that I'm working with that were right there when it was the high, I think they are so relieved what has happened over the last few weeks. And
well, I know the one buyer that we're working with over the last week, just a quarter percentage point difference. It just makes a huge
difference in their payments.
Yeah. So and just know, I know we talk about this a lot, but you're not stuck with that rate forever. Get into the market now. Come on.
Date the rate, marry the house.
That's right. Yeah. So at the mortgage company, if you buy with us, if you go through your purchase, we'll waive our lender fees to get you into that interest rate that we're hoping to see in the next 12 to 18 months.
The mortgage company.
Yeah, we're like Ohio State University. It's the
mortgage company. Patrick Williams.
We are
the mortgage company.
That's right.
I'm not the RE/MAX professionals. We're just RE/MAX professionals.
You're the dynamic home team.
We are the dynamic. Well, I don't know. No, we're not. We're just,
dynamic.
Home team.
Oh, okay.
Well, great. Well, hey, thanks for that.
Yeah. I'm excited to see rates coming down.
Yes, we are excited too. So if there's anything we can help you with, don't hesitate to reach out to us. But I think that ends our podcast for today.
I think that's it. Yeah.
Okay.
If you found this podcast helpful, please give us a like, share. You can find us on YouTube, Spotify, and iTunes. Thanks.
Bye.